to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
I feel so unworthy of that introduction. Anyway, yep. Welcome back to the Bullington Capital Report. Also available on iTunes. Also available on the Fish's website, 955thefish.com, as a podcast. And we're going to be talking today about a lot of different topics. Feel free to call us, 216-901-0945. 216-901-0945. Feel free to go to my website to learn more about us. It's Bullington Capital Management. Got a seminar coming up March 8th. That's a Thursday. Going to start at 6:30. And I think it's going to be fun. The first portion of it, by the way, I'm going to show some stocks, some individual things that you can do with stocks on your own, because I think it's a great hobby. It's one of the few hobbies in the world that can actually make you a lot of money. Most of them cost you a lot of money. But so if you like that sort of thing, I think it's kind of fun. Anyway, what we're really going to be talking about is estimating the impact of a financial crisis on your investments. Yesterday we had a 2.5% down day in the market. A lot of people are really upset by that. And I'm looking at it and I'm going, no, that's overdue. That's really overdue. I mean, you see how smooth? Look at a chart of the Dow Jones Industrial Average, the S&P 500, even the small cap indices, which have underperformed big time over the past couple of years. So if you got money in mid and small cap and you haven't kept up with the S&P, don't feel bad. Your day is coming. We're going to be talking more about that a little bit later in today's show. Don't feel bad. If you've underperformed over the past couple of years, it's because you're in smaller companies in your portfolio. Smaller, and a lot of the mid-cap value, they've underperformed by a mile. The good news is, in the long run, they have a tendency to catch up. So if you're, and that's part of what the, estimating the impact of a financial crisis, the people that are investing today, putting new dollars in, are putting dollars in the wrong category. Surprise, surprise. They're putting their money in the category that's just gone up the most, which has been leading now for almost 3 years. The fact that one category has led for 3 years in a row, kind of eerily similar to the late 90s. I don't know if you remember how that ended. So there's but I'm not saying we're there, because we're not. The valuations are nowhere near as high as they were back then. Stocks are selling at a much more reasonable level, given the level of sales and profits that they're generating. And I'm going to show you how to do that at that workshop. There's a thing called the price to sales ratio. And I'm putting out, I've actually written a ton of guides. And this is really funny. I forgot about a lot of the articles that I'd written. I rarely go to this one Google account that I set up years ago. And I went to it over the week last week. And I saw, I don't know, there was probably 150 articles that I wrote but never published. I have a tendency to do that a lot. I'll write it and I look at it going, no, that's not good enough. And, there it sits. But some of them I was going through and I'm going, oh, that's actually not that bad. In fact, it would be good for this upcoming seminar. Price to sales ratio. How do you know if a stock's overpriced or not? How do you know that NVIDIA, which a lot of people love, they love it because it's gone up so much. How do you know that you should not be holding on to that stock? How would you know that? That stock's gone from 36 to 233 in the last 3 years. And we've owned it a couple times. And it's been profitable. I did not buy it at 33 and hang on to it and get 454% because it got overpriced. And you know what? I'll give that up. Because that's what happened to Microsoft back in the late 90s. Microsoft back in the late 90s ran, and it got to a price level in 2000 that it didn't see again until 2015 after dropping 75%. Now, if you don't mind being down 75% and having to wait 15 years to get your money back, then go ahead and buy NVIDIA. That's what I'm talking about. It's tough. Picking stocks is not easy. You've got to, and a lot. You're going to look foolish from time to time. You will. Market loves to do that. Peter Lynch used to like to say the market makes everybody look like a chump sooner or later. But in the long run, if you're doing what you should be doing, and you will prevail. And in case you just think I'm picking on Microsoft, Intel only has to go up now about 75% to get back to where it was 18 years ago. Think about that for a second. It only needs to go up about 60%. If it goes up another 60%, it'll be back to where it was 17 years ago. Actually, 18 years ago. What the heck? Holy cow. So, again, NVIDIA is a great company. It's growing fairly quickly right now. It's not worth what it's selling for. So don't feel bad if you missed that. And by the way, NVIDIA peaked out in 2001, and it was selling at a price below that in 2015. So that's 14 years. And I like NVIDIA. In fact, I like the semiconductor space. I don't like that one. Why? Because it's just overpriced. And it was overpriced 50% ago. It was very overpriced 50% ago. And it still kept going. Why do they do that? Well, because they're stocks. That's the only real explanation. When you've watched them long enough, closely enough, you'll understand what I mean by that. If you don't understand what I mean by that, it's because you haven't been looking at it long enough. It's that simple. So anyway, how do you protect yourself against investing in overvalued stuff? Because stuff that's overvalued eventually comes back to being fairly valued. You know how that happens? Share price comes down. That's how that happens. If you're looking at making investments, I hope we get the 10 to 15% correction that normally comes every 12 or 18 months that we haven't had for almost 3 years. I hope we get a correction. I don't like to see things that are overpriced continuing to go up. You know why? Because it ends up like it did in 2000. And everybody that's been doing something other than just buying the largest company tech stocks, growth stocks, is scratching their heads going, how come I'm not making that kind of money? Well, because you're not participating in the fallacy. You're not participating in that bubble, and it's going to bust, and then you'll be glad that you didn't. You'll be happy. And my hope is that the market would slowly rotate out of those stocks that are overpriced, let them come down gently, and then into the categories that are underpriced. That would be my hope. It typically doesn't work that way, by the way. Normally get a big drop, everything drops, and then sooner or later the money does start to flow into those areas that are undervalued and have been neglected. Now, having said that, I got this information from a company that I do a lot of work with. The company's called First Trust, one of the biggest ETF providers in the country. And they don't sell directly to the public. They do a lot of stuff for us. The investment advisors got a lot of phenomenal research. I love some of their economists. They used to work at pretty high positions in the government. They still have those contacts, which is very nice. And they're very eager to share their research with people like me. And part of their research was showing just how much money has been flowing into bonds versus stocks. And over the past several years, despite the fact that bonds are not doing well. Remember when a guy called into this show, it was probably 2 years ago, and who was really happy because he had bought the long-term treasury bond and it was up that year or the few months that he bought it. He's probably really sorry now. And that's what we were talking about. This stuff is, by the way, it's slow. Markets don't move super fast, especially when you want them to. And I think they do that on purpose. They don't move fast when you want them to. But anyway, long-term treasury is not a good bet. Not a good bet. The interest rate's pretty nice on it. If you go back to 2015, long-term Treasury ETF is down 13% over that time period. So over 3 years, it's down 15% or 13%. It was paying less than 3% at that point in time. Right now, it's paying right around a little over 3%. But still, you'd be negative if you reinvest it. And by the way, the income that you were getting from the fund, you had to pay taxes on. It was completely taxable. So if you reinvested your dividends, you're negative 3 years. On the other hand, if you're buying some of the high yield, let's say over the past 3 years, you've got a slightly negative. It's down less. Now, it was down more in 2016. That thing dropped like a rock, but it's rebounded since then. It'll be down 6%. Oh, by the way, because your yield was right around 5% for 3 years, you'd actually have a profit. Do you hear what I'm saying? So come to the seminar because we're going to talk about that, particularly fixed income. Where should you be in fixed income? There are some places where you can get a decent yield, something higher than what you're going to get in a CD, but not take the risk of having long-term bonds. And incidentally, one of the categories that tends to do well when the economy is expanding, there are high-yield bonds. High-yield bonds tend to move more in line with the stock market than they do the bond market. And incidentally, if you look at a chart on a high-yield bond fund yesterday, looks like a big drop. It was only 0.63%. Not nearly as volatile as the Dow was, down 600 points, which is actually only 2.5%. I mean, that's really not anything to get upset about. But the media loves to beat that drum. 600-point drop. Yeah, well, it was 24,000. So, I mean, come on. Yeah, it's only 2.5%. And if you want to help yourself as an investor, think in terms of percentage. Don't think in terms of points. People make that mistake all the time. That is a rookie, novice mistake. Quit being a rookie. If you want to quit being a rookie, I should say, let me put a more positive tone on that. If you want to be more like a professional, think in terms of percentage move instead of how many points did it drop. Because percentages is what really matters. Percentages are what really matter. When you're in your, I was asked to speak on target date funds, by the way. We'll get to that probably after the first commercial break, which is coming up here in just a couple minutes. But I'm going to talk to target rate funds and what people should be doing with those in their 401ks. You want to be avoiding bonds, basically, both in your 401ks, your personal investments. Not all bonds, just the longer term tax-frees, because the interest rates on those are super low, and also the treasuries. You want to avoid long-term bonds. I wouldn't even go with the intermediate term at this point in time. The average, the aggregate bond index, that fund that's out there, I think it's a Vanguard fund. Its exposure it's too long. The average maturity on the bonds in that fund, they're too long. They're slightly too long. In fact, you look at that one. Look at it since September. It's down about 3.25. So it's wiped out all the interest and then some, just over the past few months. So it's a little too long. That's too much. That's too much risk. You're not getting rewarded for that. At the seminar, we'll talk about. I'm going to go into a little more detail into what you can do for fixed income to get yourself some income. To try to reduce the overall volatility. Interest rate risk right now is the biggest risk. The credit risk is not as bad. That's why you want to be looking at high yield bonds in your fixed income portfolio. That's a big deal. It's going to make a big difference. Over the next 5 or 10 years, it'll make a very large difference. Another thing that should make an incredibly large difference in your portfolio is the stock side. The stock side, what you're investing in stocks right now, is going to have a big impact on you 10 years from now. May not be this year, may not be next year, may not be for 4 or 5 years, but eventually what goes around comes around, and these stocks that have just gone up the most, they're gonna either go sideways or go down. And how it often works out is that the stocks that have gone up the most go down a lot. The other stocks that haven't gone down or haven't gone up as much don't go down quite as much, and then tend to recover faster than the ones that go down a lot. So that's why investing is so tricky. It's so counterintuitive. And markets change over time. A lot of stuff that worked 5 or 6 years ago doesn't work at all anymore. A lot of other stuff works better than it did. That's kind of interesting. We'll be talking about that at the workshop as well. What's working better now than has worked in the past? What was working in the past that's not working very well anymore? Things change. Markets do change. So you have to make adjustments from time to time. That's why I'm not a big fan of setting stuff and forgetting it. I just don't think that's a good idea. I've seen a lot of people get hurt really, really badly doing that. So it's not rocket science. And I guess one of my strong points, I have so much interest in this field when I started working in it, and even in college, that I had so much interest in it that I learned as much as I could, and I try to help people by explaining it in English. I know the math. I can spit out the formulas for standard deviation. I can tell you that returns are not normally distributed, that they're big fat tails, and anybody that's knows a lot about statistics knows exactly what I'm talking about. The rest of you wonder what the heck I'm talking about. That's okay. You don't really need to know. All you need to know is that looking at standard deviation, when you hear that term, it's incomplete. Unless you've got a pretty good understanding of math, it's going to be very difficult for you. I'll put it into English for you. Okay? Standard deviation is very similar to fluctuation. It's very similar. And how much fluctuation are you willing to put up with in your investments? Now that's a key. That's one of the things that you want to, that's actually the key to your portfolio, to being successful. How much risk are you really willing to take? And I can tell you the number one issue novice investors have is they look at the things that have just gone up the most and they think, man, that should have been me. I should have been in that. Well, you have to have a crystal ball that works to do that. We'll come back to the second most common mistake they make and how you can avoid it after these messages. This is Bill Bullington on 1420 The Answer. Stay tuned. And we're back. Hey, if you'd like to call 216-901-0945, 216-901-0945, feel free to give us a buzz. And I will remind you of the seminar coming up. And the seminar's major topic is how you can protect yourself during a financial malaise or financial crisis. It's actually estimating the impact of a financial crisis on your investments. But a big part of that is how do you protect yourself? How do you avoid those things that are avoidable? Some things are completely avoidable. Some things are not avoidable. Fluctuation in your account value is not avoidable unless you're in CDs. So if you're in stocks, bonds, they're going to fluctuate. So how do you know how to keep it to a level where you don't get too much fluctuation so that you're uncomfortable at night when you're trying to sleep? And that's very difficult to do. It's actually kind of difficult to estimate for an awful lot of people. That's why you really need to sit down and have a conversation. Have a conversation with an advisor. I went to a meeting this week, and I was just reminded what it was like when I was a part of a firm that charged commissions. And because there were a lot of people there that were from those firms and they were still operating their businesses that way. We don't charge commission at Bullington Capital. We're on a flat fee basis, or actually it's a management fee. So if the assets go up, we get a pay raise. If the assets go down, we get a pay cut. Now, whose interest do you think I'm working in? Absolutely. I put you in something that doesn't do well, it hurts me. So you hurt, I hurt. And it's a business partnership. That's what we're doing. We're not actually salespeople. We actually work with our clients. We have a vested interest in your well-being. And that's what the industry's been trying to move towards. I'm reading over the weekend that the SEC now has a rule that they're going to put in place, kind of like the fiduciary rule from the Department of Labor that we're supposed to enforce. And I think they should have done this a long time ago. And I was only reminded of that when I went to that meeting and was listening to what some of the commissioned stockbrokers were talking about. I'm going, wow, boy, did that bring back memories. I haven't been to a meeting with people like that for a very long time. Now, I have friends in the industry. I used to be a commissioned stockbroker. I just didn't want to do it. I just didn't want there to be a conflict of interest there. And there are good people in that industry, lots of them. And most of them are trying to make money for their clients. They go to work every day. They work hard. They're honest. And I know lots of them. Yeah, but not everybody is is like that. And I was just reminded, and I'm just going, wow, I can't believe they're still around, by the way. But anyway, so that's why you got to have rules like that. And when you're talking to somebody, I always ask, well, ask them how they get compensated. Well, I tell you, we have to tell you, I'm a fiduciary. And that means I'm legally required to work in your best interest. And it's been that way since I left the brokerage community. And in fact, I worked that way when I was there. That's where I started doing it. But anyway, that's typically, I would want to know that somebody has a vested interest in what they're doing and how I'm doing it. Another thing that we'll talk a little bit about, there are opportunities that have been presented. I talked a little bit about this earlier in today's show, that some things don't work as well as they used to. Other things work better. And you need to make those adjustments. And not that the other things don't work at all. They're not as effective as they have been in the past. And there are some things that you can do, relatively simple, that should help you out because those things are working better than they've ever worked. And it's kind of neat. It's actually a lot more traditional in nature. When I say tradition or traditional in nature, what I'm talking about is when I was new in the industry, they used to talk about these things called efficient frontiers and all this really fancy stuff, modern portfolio theory. And what was frustrating about it was we didn't have the tools to implement it. They said, this is what you should be doing. And then they didn't give us the tools. They didn't exist. Well, that's different. Today, the tools exist. They're there. They just happen to be buried amongst several thousand investment options. So it's like the proverbial needles in haystacks. But if you've got the tools, the tools to go and find those products have improved dramatically. So let me tell you, let me give you an example of what I'm talking about. I like semiconductors. I see them coming up on scans that I run for a small fund that I run all the time. I own several of them. I've owned NVIDIA in the past, by the way. I wouldn't own it now because it's too expensive. And I have a bias against buying stuff that's selling for 2 or 3 times more than it should be. Call me crazy, but I don't like to overpay I don't like to grossly overpay for something. And so if it goes up another 100% from here, I really don't care. And I'm missing that. It's just like the cryptocurrencies. I don't care because I know how risky those are, and it's not worth the risk for me. But that's me. I don't want to take that kind of risk. So, but anyway. So Bullington Capital, we've got this firm that we use called Folio Institutional. If I wanted to take advantage of the semiconductor, there's an ETF that invests in a basket of stocks that are all involved in the semiconductor industry, whether it's the equipment makers or the actual chip makers. And unfortunately, NVIDIA is the single largest holding in that fund, in that index. So I'm not real fond of buying that, even though revenues year over year in the United States are up 40% in that industry. Yeah, let me say that again. Revenues in that industry are up 40% year over year. The valuations on a lot of those stocks are very reasonable, extremely reasonable. NVIDIA is not one of them. So if I buy the fund, I'm going to get NVIDIA, and it's going to put more of the money in NVIDIA than any of the other stocks, and that's the one that's most overvalued. So what can I do about that? Well, I can go in because of the tools that we have at Bullington Capital. I can pull up all the other stocks. I can eliminate NVIDIA from that, put together that basket of securities, and then add it to my account in any percentage that I want. So let's say I'm really aggressive, and I'm going to put 10% of my money in roughly 30 stocks. There are 32 in that index. There's another one that's overpriced. I don't want to buy that one either. So I get this list of 30 stocks. They're part of an index. I whacked out the two that are the most overvalued and probably not going to, probably be a big drain on the portfolio over the next 4 or 5 years. They may keep going up over the next 2 years, which will make that outperform what I'm going to do. And I'm willing to put up with that because in the long run, I think I'll be rewarded. And let's say I just want to put 10% of my money, 10% of my stock portfolio, I want to overweight that one particular sector. I can do that. The technology that we have at Bullington Capital allows us to do that. We can customize that for those clients that are interested. I know when I say this, every single one of my clients that's listening to this show right now is going, hey, how come I'm not in there? Because that's really aggressive. So you will be getting an email out over the next couple of weeks. Remember when I did the bank one when Trump first got elected and all the banks took off? Those things got overpriced after like 3 weeks. And they just ran like crazy. I'm hoping that this doesn't happen because now Bill Bullington said on the radio that those stocks are underpriced and they're going to go up. I hope that doesn't happen again because I wasn't able to get very many people involved in that. Don't feel bad, by the way, because inside of the funds that I use to get the full diversification, each and every one of those stocks is already in there. They're all in there. So you do, in fact, have some exposure there. It's just not as much as if you were to take a portion of it and dedicate it just to that particular industry. And I'm going to do that personally. So I'm letting you know. I haven't done it yet. In fact, I've been struggling. I wanted to do it with a fund. I wanted to try to find a fund. I think I may have found one. I don't know. There are only several thousand of them to look at. And even narrowing it down is difficult. I did narrow it down. And, there are a couple of ETFs that go just in semiconductor space, but they're market cap weighted and they've got most of the money in the two stocks that are most overvalued. I don't want to do that. So that's the cool thing about one of the firms I use. I can create the basket of securities, allocate 5 or 10% of my stock portfolio, stock portion of the account to that particular sector. And this is one, quite frankly, I'm not going to have to watch that closely. I'm probably not going to rebalance it more than once a year. So if it's a taxable account, I'm going to get a long-term capital gains on that. So that's pretty cool. So I really like the ability to go in and customize that. And it's not hard. It really isn't hard. It's not hard for us because we have, and we're using technology that other firms, quite frankly, they're not using it. Folio is a very small firm. That always confounds me when I look at that and go, wow, people just obviously, they don't understand the power that thing has and what you can do with it. It's pretty interesting. And even if you did just want to buy ETFs, you can buy ETFs. In fact, First Trust, that company I was mentioning earlier, does a lot of research, provides a lot of research for people like me. Very good research, I can tell you. Looking at all the research I've looked at over the years, I really like their approach. Very pragmatic. They hire people that used to hold big positions within the government when they decide to step down from the government. So these guys are connected. They have really good information. It's awesome. And they're willing to share it with us. And they've got a fund that they're putting together. And I don't know if I don't want to recommend it on the radio because, I can get in trouble for things like that. But we'll be talking about it at that seminar because this is a big deal. This kind of stuff doesn't go away overnight. I was shocked that those banks ran up that fast. That was shocking to see them move that quickly. And a lot of them are at valuations now that are just nosebleed. In fact, if I were able to, I would be shorting a lot of those stocks. especially your small regional banks. They're selling at like twice the valuation of the big banks. They were selling right around the same valuations when I started talking about them. And then they just ran up like unbelievably quickly. It's interesting. So now the smaller banks, very few of them are selling at a reasonable, what I would consider reasonable valuation, reasonable price. A lot of your larger banks, they still are. They're still at pretty good valuations. In fact, if I was going to hold banks, I wouldn't be holding the small ones. I'd be holding the bigger ones. So those are those changes. Those if you're holding a lot of the small banks and their price to sales ratio is higher than 6, sell them. They're not worth that. Sell them. When they get bought out, it's not likely to be at a big premium. So you're going to be stuck in that stock for the next few years until somebody decides to buy them out. And they might buy them out at less. The share price may go down between now and then, especially with interest rates rising. They actually, it helps them out a little bit. Doesn't help out their bond portfolio, though. Anyway, so there's a lot of stuff going on. And a financial crisis comes along. How's it going to impact your investments? That's kind of a big deal. It has a tendency not to impact the companies that are not overpriced as much as the ones that are overpriced. Spend a lot of time talking about how you figure out whether or not something is overpriced. It's really not that hard. You do not have to learn discounted cash flow calculations. I know that's the favorite of chartered financial analysts out there many times. And those guys should take a look at what I'm doing. It's a lot simpler, and you don't really need a computer to do it, and you don't have to make a whole bunch of assumptions about what the inflation rate, what the risk-free rate of return and the risk premium should be. You have things that you can't possibly calculate. You have to take a guess. Sounds really good on paper. Sounds really impressive. Not very helpful. So I want to avoid that kind of stuff. Just avoid it. The discounted cash flow, that's fine. And I'm telling you, when you look at what I'm going to show you at this seminar, you're going to go, wow. I wish I'd have looked at that earlier. Me too. I didn't figure that out for 20 years, I think. It took me an awfully long time to figure that out. And by the way, if you're calling in, hang on a second. Our board operator was a little busy. The number is 216-901-0945. 216-901-0945. You got questions? And I'm going to be picking up a call right here, right now. Hey, Jerry. Can you hear me?
Yeah, hello.
Hey.
Say, I wanted to get your thoughts on the VIX, volatility index, whether that has a place in someone's portfolio at this stage of the market.
Well, it depends on how sophisticated they are. That is a really difficult thing. All it's doing is measuring volatility. And
right.
So what you're doing is you're placing a bet. That's not an investment. Okay, it's a bet. So you have to realize, you have to call it what it is. It's a bet. Volatility happens to be pretty cyclical in nature, but the cycles are always changing. So it'll be, when you go from high volatility to low volatility, it doesn't happen like on a calendar basis. I know some people say that, and it's wrong. If you look at the actual math, they're wrong. It doesn't do it that way. They're trying to sell something there. So do I think it? If you want to try that, fine. Try it. I wouldn't put a lot of money in it. I would leave it a super small amount, because if anybody could accurately predict that stuff, I could show them how to be a billionaire. No sweat. Hey, do you want to hang on, Jerry?
Sure.
Okay. I'm going to take a real quick commercial break. You listen to Bill Bullington right here on 1420 The Answer. Stay tuned. And we're back. Hey, Jerry, still there?
Yeah, still here, Bill.
Yeah. Okay. Yeah, I don't know that I would spend a whole lot of time on that, because when you're betting on the volatility, I mean, that's really not an investment. I mean, that is incredibly speculative. And if it were really easy to do, or if it was even relatively difficult to do but doable on a somewhat consistent basis, you could get really, really rich The fact that people aren't really, really rich doing that's got to tell you how hard that is. Because it'd be really easy, man. Pardon me?
Yep, got it.
So,
all right, Bill, thanks very much.
All right, have a good day. Thanks. And I got Bruce. Bruce, you're on the Bullington Capital Report.
Hi, Bill.
Hey.
Good talking with you. Hey, I got a question, with the recent drop, in the market.
Mm-hmm.
And I'm hearing a lot of talk on TV about, because of interest rate raising on the 2-year Treasury raising rapidly. Now it's up to 2.86. And I think what they're correlating it to is that the 10-year Treasury, if it's 3, it's going to be close to dividends that you can get from the stock market. So people are going to rotate out of stocks and into dividends into the 10-year Treasury.
Yeah, they'll be really sorry they did that.
I think of your take on the correlation between the 2-year 10 interest rate and the 10-year interest rate and the stock market drop.
Well, the correlation's very fascinating because if it were truly correlated, okay, back when the 10-year rate was down under 2%, the S&P should have been selling with a PE of 40. Okay, that would have been the equivalent. The S&P should be somewhere around 4,000. Okay, so if they were really correlated, that's what would have happened.
Mm-hmm.
So the correlation is non-existent. I shouldn't say non-existent. It's a loose correlation. And back in the early 80s, when you had short-term interest rates, or even in the 90s where short-term interest rates were higher than long-term interest rates, if they were truly correlated, the S&P should have been down, 80, 90%. So the correlation's there for a little bit of time, but they're really not that highly correlated.
Okay.
Over long time periods, maybe, somewhat. In fact, I like to use the long-term average, the 10-year Treasuries, long-term average, you go back over about 100 years or so, it's about 5%. That's the long-term average. It hasn't been 5% in quite a long time. And if it is 5%, then the correct price to earnings ratio for the S&P is 20. Okay. So you had an S&P that's been around 20 now. It's around 20 times earnings, 20 times forward earnings anyway. But the 10-year Treasury's been a lot lower than 5%.
Right. So
correlation not too existent for the last 20 years or so. And so that's my opinion on it. It's not very well. The correlation is very poor. So in other words, you're not going to get a whole lot of benefit from looking at it or using it.
Mm.
So
okay. No, I just wonder why these the traders on TV.
Well,
talking about it.
They've got 24 hours worth of. Actually, I don't know. They're not open 24 hours. They have to fill airtime every day.
Exactly.
I only have to do 45 minutes a week.
No, I understand that.
I feel bad for those guys.
But, when you hear from the actual traders themselves,
they're not trading. Those guys on television are not trading. I promise you that. They are not traders. They're journalists. There's a big difference. They may have traded at some point in time in their lives, they'll say things because they have to say it. It's like the fake news gets more hits than real news does. You know that? especially the more outlandish that it is. And I think it's a riot. I mean, I can't believe it. You're on the internet. It's almost, remember Star Magazine? Remember that magazine?
Yeah.
It's called Star Magazine. Yeah. Well, now that you have the internet, those guys went away. And that's what you see. A lot of stuff. And it's just not true. I mean, it's unreal. And it's so hard. I mean, because I've been fooled multiple times. And that's why I don't believe anything I see or read until I've got about 8 sources that I feel like are at least semi responsible that are reporting the same thing. So it's made my job a lot harder. I have to constantly look up these things. And there are some really good sources online, though. I mean, Bureau of Labor Statistics is pretty good. The Energy Information Agency is pretty good. Yeah, there's Congress has to report everything they do. That those things are too long to read, by the way. you read about the laws that make it to the floor just on a daily basis. It's mind-boggling. But anyway, is there anything else I can try to help you with?
We were talking before about the price to sales ratio of semiconductors. What number do you like in that space, or just in general? Is it
well, this is what's really wild about the semiconductor space. I got to tell you, I never say buy and hold. Okay, I mean, I never say buy and hold because everything gets overpriced at some point in time. Okay, and it gets underpriced at some point in time. But if you were to buy something, you wanted to buy something to kind of hang on to for a while, that you're not going to really have to pay too much attention to, I would look at the semiconductor space, and here's why. Back when I was when my hair was a lot thicker and darker, yeah, I was buying computers about once every 6 to 9 months because the processor speed would jump so much that was really worth it for me. It was really worth it because the data that I have to crunch is so intense, and the machines took so long to do it. So there was a cycle of semiconductors. A new Intel would come out with a new semiconductor, and AMD, by the way, would come out with their version of it. They were former Intel employees, by the way, that started that company. And then NVIDIA and all the other companies that made the other processors to make these computers faster, they would come out with a new model, and then Microsoft would increase the lines of code large enough to slow that down. And there was a cycle. They talked about the cycle all the time. Well, now semiconductors are in everything. They're in your car. They're in your refrigerator. The cheapo calculators that they've always been around. The computers, the cell phones, your televisions. I mean, they're in everything. So it's actually much more like a consumer-based product now. The demand is much more consistent than it used to be. It doesn't swing like it used to. But and you used to see the price to sales ratios go from like 0.5 in a down cycle up to 7 or 8 when it was peaking. That was a gigantic swing. That's one of the reasons I used to like to trade those long-term trade. I never day traded. I would look for a big move in some of those stocks because they would move so far in both directions. Today, the demand for their product is the highest level it's ever been. In fact, revenues for semiconductor equipment and manufacturers is up 40% in the past 12 months. That's unreal. 40%? That's crazy. So the price to sales ratios on a lot of those stocks are like 3, 2.5, some of them 4 or 5. Then you get up, NVIDIA is like 20. That one's like way out there. But I think as an industry, if you buy a basket of those stocks, I think you're going to do incredibly well because the demand is so much more consistent than it's been in the past. And these cars, the 5G, wait till you see. Driverless cars are coming. They're coming. And the fastest growing segment of the population is 62 and over. Okay. And there are a lot of people in their 70s and 80s who are sitting at home. There's a tremendous amount of pent up demand. You know how they would love to go out for lunch and meet their friends for lunch, but they can't drive? They would like to go out to a movie, but they can't drive. They'd like to go out and pick up some groceries, but they can't drive.
Good point.
When those cars, when Uber sends a driverless car to their house, and we're pretty close to that. It's getting there. And the cars that they need to work on that, they need the 5G technology to make that work. It's all coming. I feel like I'm looking at one of those Timex computers they used to advertise in the 70s that you plugged into your television set that was black and white, probably. Those guys are actually a little farther along than the PCs were at that time period. And that's a beautiful thing. And nobody that I know of has talked about that. The pent-up demand from people who are at home, who can't drive. They're the ones with all the money. It's sitting there in their investment accounts. Believe me, and so when that starts to hit, I think the economy, you could experience a pretty rapid expansion. It might be like the 1980s when the price of oil came down from $35 a barrel to $9 because they had seismic technology. Instead of hitting 1 out of 2 wells, they hit 9 out of 10. And that has the capacity to do something like that. There's an unbelievable amount of demand that's going to be unleashed. And I kept hearing all the naysayers talk about, the population's aging and they're not spending, and we're going to have to take care of them. The companies that take care of people that get old and sick, they seem to be doing really well. You ever notice how everywhere you go, you see a Cleveland Clinic operation? Anyway, Bruce, right. I'm sorry, we're running out of time. I appreciate the call. Maybe we can call back next week and continue on the conversation. But have a good week. All right, thanks. You're listening to Bill Bullington right here on every Saturday morning on, I can't talk today, 1420 The Answer. Have a good week, everybody. Good luck and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420 The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.